Welcome to the Deep Dive.
Hey there.
Today we're cracking open a specific source, a recent earnings call transcript. We want to get a really clear picture of a company's performance and, its outlook.
Right. Our mission here is basically to cut through all the prepared remarks, the jargon you sometimes get, and really pull out the important bits from this transcript, understand what actually happened last quarter, and maybe more importantly, what the company's signaling for the future.
Exactly. And the company we're focusing on today is Backblaze. They're a player in the cloud storage market.
A pretty interesting one.
Yeah. So for you listening, this deep dive is going to unpack the latest on their operations, their strategy, financials, all straight from the source material.
Let's see what nuggets we can find.
Okay, so where do we start? Maybe the headline numbers.
Yeah, absolutely. Looking at the sort of top level view first, the company delivered pretty strong results this quarter. They actually exceeded the high end of their own guidance for both revenue and adjusted margin.
Oh, interesting. Always good to beat guidance. What were those actual figures?
So overall company revenue, it grew 15% year over year, came in at $34.6 million. But the real standout, I think, was their B2 cloud storage segment. That's actually their largest business now.
Right.
And it kept up its momentum. Organic growth actually accelerated for the second quarter in a row, hitting 23% year over year.
Okay, strong top line growth, especially in that core B2 segment. How did that, filter down? What about the bottom line?
Yeah, significant improvement there too. Their adjusted margin actually tripled compared to the same time last year, reached 18%.
Wow.
Yeah, and they made really substantial progress on adjusted free cash flow as well. It improved dramatically. I mean, it was negative 17% a year ago, negative 3% last quarter, and now it's only negative 6% this past quarter.
That's a pretty swift move towards getting into positive territory on cash flow.
Yeah.
They mentioned something about a rule of 40 target, didn't they?
They did, yeah. So if you combine that B2 revenue growth and the adjusted free cash flow margin in this single quarter, they went from a combined 9% last quarter up to 17% in this one. They see that big jump as a strong step towards maybe becoming a rule of 40 company down the line. That's that benchmark where revenue growth plus profitability margin adds up to 40% or more. Kind of a key thing for growth stage SaaS companies.
Right. The magic number. Okay, so beyond those headline growth and profitability numbers, what else stood out in the financials?
Well, we should probably look at the computer backup business too. It did see some growth, up 8% from the prior year.
Okay.
But the transcript notes that this was mostly driven by a price increase they pushed through back in 2023. And they expect that specific impact to kind of taper off in the next quarter.
Got it. So price-driven bump mostly. What about net revenue retention, NRR? That's always a key metric for subscription businesses, right? Shows if they're keeping and growing existing customers.
Exactly. So overall, NRR came in at 113%. That's up slightly from 112% a year ago.
Okay.
For the B2 segment specifically, NRR is still strong at 117%. But the transcript does mention that the B2 NRR is down from 126% last year.
126 down to 117. What's behind that dip?
It's mainly attributed to lapping, comparing against the impact of that 2023 price increase we just mentioned. That price hike boosted NRR last year.
Ah, makes sense.
Yeah. So they expect NRR to kind of stay around this 117% level for a few quarters while that higher revenue growth rate we talked about starts flowing through. But critically, gross customer retention, just how many customers stick around, that remains consistently strong. About 90% across both segments.
That signals pretty high customer loyalty.
Definitely, which is a good sign.
For sure. Let's shift to gross margins. How do they perform there, profitability-wise?
Yeah, saw improvements there too. GAAP gross margin, that's a standard accounting way, was 56%, up from 53% a year ago.
Okay.
And adjusted gross margin, which usually strips out things like depreciation, that improves to 79% from 77%.
So what's driving that margin improvement? Is it just the revenue growth?
There's a couple of things, really. First, they mentioned increased efficiency in their data center operations, just running things tighter.
Right.
Second, looking ahead, they actually anticipate getting another 200 to 300 basis points benefit to their GAAP gross margins starting next quarter.
Oh.
By extending the useful life of their hardware to 6 years. They did a recent evaluation and basically determined their servers and stuff last longer than they previously accounted for.
Ah. Okay. Extending asset life can definitely juice the margins over time.
Yeah.
They also touched on potential outside factors like tariffs.
Yeah, they did. They estimated that hypothetically, if there was a 10% tariff on all U.S. imports, including their storage hardware, it would probably increase their cost of sales by about 1.5%.
Okay, 1.5%.
Manageable.
Seems like it. And here's the key thing. Because the impact of buying hardware gets spread out over that 6-year life of the asset, tariffs would need to be, significantly higher or hit a huge volume of purchases to really move the needle on gross margin in any single quarter.
Right.
Plus, they source hardware from multiple countries, which helps hedge against those kinds of supply chain risks anyway. Okay, so operational efficiency, accounting changes helping margins, tariff risks seem kind of contained for now. What about operating expenses? OpEx.
They saw some benefits there from the restructuring they did last quarter. R&D and G&A expenses were pretty much in line with what they expected. Sales and marketing actually came in lower than anticipated.
Lower on sales and marketing. Why was that?
Primarily seems to be due to hiring slower than planned in that area and also shifting some marketing campaigns into the next quarter.
Okay.
They do anticipate sales and marketing expenses will increase, though, by about $2 million next quarter compared to this past one as they ramp up that hiring and participate in some industry conferences.
Got it. Looking further down the income statement then, how did overall profitability look beyond just EBITDA?
The net loss margin improved significantly. It was negative 37% a year ago. Now it's negative 27%.
That's a decent improvement.
Yeah. And like we mentioned earlier, adjusted EBITDA margin tripled, up to 18% from just 6% in the prior year.
That's a huge jump in adjusted profitability. What was the main driver there?
It was mostly driven by that strong revenue growth, combined with keeping expenses pretty steady or even slightly down in some areas like S&M this quarter. They finished the quarter with $53 million in cash and marketable securities. That was a slight decrease, about $2 million from the previous quarter.
Okay. They also highlighted focusing on reducing equity dilution. Why is that a priority now, and what are they doing about it?
Well, as their free cash flow improves, they're making a deliberate effort to cut back on dilution from employee equity awards, stock options, RSUs.
Right.
So they've started settling executive tax withholdings in cash instead of shares, which means fewer shares hit the open market. They also plan to gradually shift from giving annual bonuses in equity to giving them in cash.
Okay.
It all basically means issuing fewer shares over time, which is generally good news for existing shareholders.
Beyond the financials, they also mentioned some important progress on compliance and audits.
Yes. They highlighted successfully remediating their SOX material weaknesses, SOX being Sarbanes-Oxley, the financial reporting law. A material weakness is a significant issue.
Right. You don't want those.
Exactly. And they confirmed this fix in their 2024 annual 10K report, which is that big annual filing companies have to do.
And they switched auditors as well.
Correct. They've appointed Deloitte as their new auditors. They mentioned this is part of preparing to be 404B compliant. That's a section of SOX requiring external auditors to actually sign off on management's internal controls.
Okay.
They cited Deloitte having strong capabilities and also expected cost savings compared to their previous auditor.
Okay, so summing up the quarter, strong results, improving financials, making progress on compliance stuff. Let's talk outlook. What are they guiding for the future?
Right. For the next quarter, Q2 2025, they expect revenue between $35.2 million and $35.6 million. They're targeting B2 revenue growth specifically between 23% and 25%. And adjusted EBITDA margin is projected in the range of 14% to 16%.
That EBITDA margin guidance, 14-16%, that's a bit lower than the 18% they just posted in Q1. Any color on why?
Yeah, the transcript mentions it reflects some seasonal factors that usually hit Q2, plus that anticipated increase in sales and marketing spending we talked about earlier, the hiring ramp up in conferences.
Got it. Makes sense. And what about the full year?
They're actually maintaining their full year revenue guidance, keeping it at $144 million to $146 million. But importantly, they are raising their full year adjusted EBITDA margin guidance. It was 16-18%. Now they're guiding to 17-19%.
Oh, interesting. Raising the profit guidance, that signals some optimism.
Definitely suggests increasing confidence in their ability to keep those profitability gains going through the year.
Okay, but they also acknowledged, didn't they, that some customers are taking a bit more time to make decisions, the current business environment. How do they square that potential caution with their confidence in accelerating B2 growth?
Yeah. That's a really key point. Despite some, let's call it macro slowness affecting customer decision cycles, they still sound confident they can accelerate B2 growth each quarter this year. They're targeting at least 30% by Q4.
30% by Q4.
Yeah. And also achieve positive adjusted free cash flow in Q4 as well.
So what's driving that confidence against that backdrop of general caution you hear about?
They highlighted a few key factors. One is their strong self-serve business model, which they feel is less impacted by slower enterprise sales cycles.
Okay.
They also noted their sales bookings more than doubled year over year in Q1, which shows pretty strong execution from the sales team. And just the recurring nature of their business, customers store data, they tend to keep storing it. That provides a baseline of predictability.
Right. Storage is sticky.
Exactly. Let's maybe dive a bit deeper into some of the strategic stuff, particularly around those high growth areas like AI and their new offerings.
Yeah, the AI opportunity definitely sounded like a significant theme on the call.
Absolutely. They really see Backblaze as a great platform for AI use cases. And the why is interesting. It offers high performance but low cost object storage that supports the open cloud.
Okay, open cloud flexibility. Why is that crucial for AI?
Well, AI companies often need to easily move massive data sets between different compute providers, right? Especially those offering specialized hardware like GPUs, the graphics processing units you need for AI model training. Being open makes that easier.
Gotcha. And they backed that up with some pretty wild numbers about their AI customer growth, didn't they?
They did. Their AI customer base grew by 66% just in the quarter.
Wow.
But here's where it gets really interesting, I think. The amount of data these AI customers are storing with them grew by 25 times.
25 times. In one quarter, that's exponential. What does that huge data growth per customer tell you?
Well, it suggests that this isn't just about adding more AI logos, right? It signals a really powerful land and expand dynamic specifically within AI. Once an AI company starts using Backblaze, their storage needs just explode.
Right.
It suggests these customers are scaling up fast, maybe constantly feeding new data for model retraining, storing massive data sets for analysis, handling huge outputs. It really highlights that Backblaze's platform isn't just attracting AI companies, it's actually supporting their most demanding, data-hungry workloads.
Interesting.
Yeah, they noted seeing various AI use cases across their pipeline: data creation, labeling, model building, inference, retraining, citing examples like autonomous vehicles and drug discovery. And tellingly, their single largest customer by storage volume is now an AI company.
That sheer data growth from AI customers really shines a spotlight on the need for storage performance. And that ties directly into their new offering, B2 Cloud Storage Overdrive, right?
Exactly. They launched it recently. Overdrive is specifically optimized for very fast performance, particularly with large data sets and high throughput. It's designed for exactly these kinds of jobs: AI, machine learning, high performance computing, CDN origin stores, big analytics.
What's fascinating to me here is they mentioned achieving these speeds, which you often associate with really extensive flash storage, using their existing platform and spinning hard drives.
Yeah, that was impressive. They leveraged their own differentiated IP and some past work, like a project they called Shard Stash, which was focused on optimizing how data is accessed and retrieved across distributed storage.
Okay.
So while there were some hardware changes involved for Overdrive, the transcript emphasizes that a big chunk of the performance leap came from software optimization on their existing infrastructure. They even said they were hitting performance levels that were actually surprising some prospects.
That's impressive engineering. And how does the pricing compare for this high performance tier?
Overdrive starts at $15 per terabyte per month. That's about 2.5 times their standard B2 price.
Okay.
But the transcript gives a really powerful example of its competitive value, especially against the big hyperscalers. They cited a scenario: a 10 petabyte customer sending data out 3 times a month, egressing it.
Yeah, retrieving it.
That could cost around $1.7 million per month on AWS. On B2 Overdrive, about $150,000.
Whoa.
Yeah, that's roughly 90% less expensive for similar intensive workloads. And a huge part of that is their free egress policy. They don't charge you to pull data out of storage, which hyperscalers often do, and it gets really expensive for high volume use cases like AI. They're already seeing inbound interest from Fortune 500 companies for Overdrive because of this.
That value proposition for performance sensitive high egress workloads, that does seem like a potential game changer. They also updated on their go-to-market transformation efforts. What are the key areas there?
They're really focused on 3 things: upskilling their team, building out partnerships, and refining their sales plays.
Okay. How's the upskilling going?
They've seen great momentum, apparently. The sales team more than doubled bookings year over year last quarter, partly through strong execution, partly growing existing accounts. They finished building out the sales team structure, and the new hires are about halfway through their ramp-up period. They also hired a VP of customer success to improve onboarding and post-sales support, which is obviously crucial for keeping customers and expanding them.
Right. And partnerships.
They've established some new technology alliances. For AI workloads, they're partnering with high-performance compute providers, mentioned QNodal specifically. In the media and entertainment space, they're seeing momentum with cloud-first workflows, partnering with companies like Suite Studios and Iconic.
Okay.
These kinds of collaborations basically let teams manage, ingest, index, stream content directly from the cloud, often at a fraction of the cost of traditional on-premise infrastructure, even in a tight budget environment.
So, partnering up to extend their reach into key verticals. And the sales plays. What's happening there?
They've revamped their marketing efforts to align better with their 4 key sales plays. Things like optimizing content for search performance, restructuring the marketing team, adding customer insight tools to better target their efforts.
Got it. A pretty significant proof point of their go-to-market success seems to be their ability to sign larger deals, which they specifically highlighted.
Yes, they did. They announced signing their largest TCV deal ever, that's total contract value, a multi-million-dollar, multi-year contract.
Nice. And what's particularly insightful about this specific deal?
Well, this customer, who offers a popular application, was actually just a smaller customer only a year ago. And they decided to migrate their entire data set from AWS over to Backblaze.
From AWS. Wow.
Yes, this isn't just, gaining a new customer. It's a direct displacement of one of the major hyperscalers.
Migrating an entire data set from a hyperscaler to Backblaze.
Yeah.
That's a really strong validation point. Was this large customer migration specifically driven by that new Overdrive offering?
Actually, no. The transcript notes that this specific customer's use case didn't require overdrive speeds. The key factors in their decision were apparently their familiarity with the Backblaze platform from being a smaller customer already, its performance for their needs, the overall value proposition compared to AWS, and the customer service they received.
Interesting.
So it really validates the core B2 offering and their ability to scale with customers and sort of land and expand even against the biggest players out there.
So winning against hyperscalers is definitely happening. When they discussed the competitive landscape since their IPO, they reiterated it's still a huge market, right? Amazon, Google, Microsoft are the big guys.
Right, they acknowledge that. But they still see ample opportunity. They continue to win customers both from the hyperscalers companies looking for better value or maybe different performance characteristics, and also from companies migrating to the cloud for the first time. They described their win rates against competitors as world-class, actually. The focus remains on cranking up those go-to-market efforts to boost awareness and just generate more opportunities.
Okay. And while they acknowledge the macro environment is causing some customers to take longer to decide, they also mentioned seeing a bit of a counter trend.
Yes. Exactly. Their value proposition, that 80-90% lower cost compared to hyperscalers for many workloads, the free egress, the open cloud support, the high performance, that's actually particularly attractive in an environment where companies are really focused on squeezing more value out of their budgets.
Makes sense.
They've even seen some customers who might be slower on signing big committed contracts instead move faster on just a pay-as-you-go basis, which has apparently shown solid momentum.
Right. In a cost-conscious world, value really stands out.
Yeah.
Okay, we've pulled a lot of threads from this earnings call transcript. Now let's move to our not financial advice segment.
Ah, yes. This is where we take a look at all this information, and purely for illustrative and, let's face it, entertainment purposes, we conjure up a kind of outrageous but plausible trade idea. The sort of thing you might hear a junior analyst pitch in a brainstorming session before being told to refine it heavily.
Okay, so given the themes we've discussed, winning these large deals from hyperscalers, the significant growth and strategic focus on AI and performance storage with Overdrive, the operational efficiency driving margin improvements, that clear drive towards free cash flow positivity.
Right. How about this highly speculative idea, just connecting some dots from the transcript? You structure a pairs trade. You go long Backblaze,
Okay.
betting on their continued execution on those operational efficiencies, the successful ramp up of AI workloads, and the traction of Overdrive driving those higher value revenue streams, and maybe pulling forward that free cash flow break-even point.
Right. And the other side of the pair.
At the same time, you short a tiny, almost symbolic fraction of the stock of a major diversified hyperscaler, maybe one that's publicly talked about some softness in general cloud spending recently.
Okay, I see where you're going. The idea being you're not betting on the whole hyperscaler business collapsing or anything.
Oh, not at all.
You're using that small short position as more of a symbolic hedge against broader macro cloud spending slowdowns, except in those specific high-performance, value-sensitive niches where Backblaze seems to be really making inroads, particularly with AI and overdrive.
Exactly. The outrageous premise here is that Backblaze's focused growth in these specific high-value niches, coupled with their operational improvements and that value prop that's actually causing migrations from hyperscalers, that could allow their stock performance to potentially outpace the marginal impact of broader macro caution felt by the massive, diversified hyperscaler, at least during the specific time frame this theoretical strategy plays out. It's kind of the niche innovator stealing high-value workload share narrative play, just slightly hedged against general market softness.
Outrageous, yes. Plausible, maybe just barely. And absolutely remember,
this is not financial advice. Seriously, do your own research. Please consult with a qualified professional, and probably don't try that particular trade at home. It's just us having a bit of fun connecting the dots from the transcript in an extreme kind of way.
definitely. Okay, so pulling back from this deep dive into the Backblaze earnings call transcript, we've seen a picture of a company that, appears to be executing pretty well on multiple fronts.
Yeah, they're showing significant operational improvements, especially driving that margin expansion and moving noticeably closer to being free cash flow positive.
And at the same time, making these strategic bets on high growth areas like AI and high performance storage with overdrive, all while, navigating what seems to be a potentially cautious macro environment out there.
And understanding these kinds of details directly from the source material, like this transcript, it really gives you a grounded perspective that goes beyond just the headlines. You see the specific actions and results driving their performance.
Right. And here's where it gets really interesting. Consider this thought. The transcript shows they're winning large deals, even displacing hyperscalers in some cases, right? And they're seeing absolutely explosive data growth from AI customers, particularly with new offerings like Overdrive that are optimized for those exact workloads. So if these strategic bets on AI and high-performance offerings really land successfully, and that's combined with operational efficiency continuing to drive profitability improvements and reduce equity dilution, how significantly could that actually reshape Backblaze's position relative to the hyperscalers, specifically within those high-value, demanding niches? What would that really mean for the competitive dynamics in cloud storage down the road?
That's definitely something interesting to think about as you continue your own learning journey. The transcript gives you the details, the data points. The next step is pondering those implications.
Exactly. Well, thanks for joining us for this deep dive today. We hope it's given you a useful shortcut to being well informed on Backblaze's latest quarter.